Hello and welcome to STRAT this week. Today we are talking eyes, inflation, interest rate cuts, Israel and even Iran, if you want to include that.
I didn't know where you were going
But
with that.
we'll start with inflation, right? So the mood in the market we've talked about has kind of started to sour a little bit, and we'll take a look at returns here in a second. And in our opinion, it seems to be primarily driven by continued sticky inflation, not just in the headline numbers we see in the financial press, but also the underlying data. So, Mike, what's leading to this inflation stickiness and subsequent market reaction?
Last week, we received the March CPI report. It was hotter than expected. Again, that's the fourth consecutive CPI report that's come in hotter than expected. The first one in that sequence was the December 2023 CPI report, which was obviously released in January, on January 11th. So that's the worry in terms of where the inflation is coming from. That's also a worry. It's something we flagged. We were talking about in the beginning of the year as to why we thought fewer rate cuts this year than consensus. And it's because the services ex shelter is just on a tear. We revised this chart a little bit. We're looking at the 4-month change annualized because of those 4 consecutive hotter than expected prints. And we're at 7.8% now. Also, the progress on shelter has stalled out.
Right.
So for those of you at home, if you're thinking about services ex shelter, what does that mean? Where are you probably feeling it right now? The line item for household operations, which doesn't mean much, but you're talking about gardening, lawn care, storage, moving expenses, any repair of a household item, you're probably going to get sticker shock there if you haven't already. And then transportation services. And there you're talking about auto insurance in particular. Check your auto insurance rates.
Yeah.
They're up huge. And then auto repair as well.
Sounds like it might be time to give myself a raise for some of that lawn care and maintenance around the house, huh?
Yeah, for sure.
Yeah.
But what this effectively does is it takes core CPI, which is not the Fed's preferred inflation measure, but it's one everybody listens to. It's very important. Year over year, we're at 3.8, nowhere near 2 or 2.5. Over the last 6 months, we're at 3.9, and then over the last 3 months, we're at 4.5. So going the wrong way.
direction.
The Fed was waiting for further evidence that inflation was on a sustained path down towards 2%, and they got the opposite of that thus far this year. The opposite of that evidence.
Yeah, and the market seems to kind of be coming to grips with that idea, right? The idea being if inflation doesn't come down, the Fed can't cut rates, and they'll have to keep rates higher for longer. And that idea is going to continue to work itself throughout the maturity spectrum of high quality bonds. And we're really starting to see that. I mean, April has been a tough month, particularly when you go out in the longer maturity and, 10-year down 3.5%, 30-year down almost 7% just in 2 weeks here as those rates, rise.
Yep. And our video that came out last week talking about the long-term attractiveness of fixed income, which is key. Because in the near term, what's happened here since January 11th, market expectations for rate cuts in 2024 went from almost 7 to now we're at less than 2 over that short a period of time.
We were supposed to have 2 cuts by now coming into the year, right?
3 months later. And, the market, the equity market, which we'll get to, took most of that in stride.
Right.
But then, as you said, that starts to bleed into the longer term areas of fixed income. So you look at the 10-year yield. Back on December 11th, we were around 4%. Very reasonable, benign environment. But now it's up to 4.7, which is key for a couple of reasons. One is 4.7 yield on a 10-year treasury is the exact same as the earnings yield on the S&P 500.
Right.
So we talked about there is alternative. Yes, cash yields are the highest on the curve. They're an alternative to equities, but now even a 10-year treasury is an alternative to equities. So that's key because that's a level relative to equities where equities start to sell off. It's actually more so, it's around 4.5. Last summer, we were in a similar type of an environment. Rate cut expectations were coming out of the market. Longer term bond yields were rising. And once the 10-year got over 4.5, that's when the S&P 500 started going down.
Right.
And we've seen that as well
Yeah.
this time
Yeah.
around.
Yeah, you have those two factors in terms of changes since, call it, the first quarter, right? Of longer term rates starting to rise and becoming more attractive, and the narrative shifting from fewer cuts to cuts question mark, right? And you can see that in the equity returns as well, right? April here, month to date, a lot of red across the equity spectrum, global and market cap.
Yep.
Yeah.
Once 10-year yields passed that level, we started to see equities sell off. And then the other thing that's just starting to show up here, it's sort of hidden in these numbers, is if you look at the Magnificent Seven, since January 11th, really only 3 of them have outperformed the broad market by any reasonable margin. Just NVIDIA, Meta, and Amazon. So the market's losing leadership, right?
Yeah.
So this, once again, very similar to the setup as we got into last fall. So we got into September, October, bond yields were high, equities were selling off.
Yep.
And the market really needed a cool inflation print and for the narrative to shift to, okay, the Fed can
Permission
cut
to
rates.
cut.
They're just looking for that. The difference this time around is large caps are more expensive now than they were last summer,
Right.
by a number of measures. So, last summer large caps they had a drawdown of about 10%. Not down nearly that much yet, but this could continue. If we see the 10-year yield go up to 5%, the levels that we reached last fall, that could continue to put downward pressure. And we're kicking off of earnings season. It's tough to say whether or not earnings this time around are enough to overcome a 5% yield on a 10-year treasury and no rate cuts.
Yeah, and you hear from the big banks kicking off earnings season, right? Talking about how, they're beating expectations, things are okay right now, but they are kind of increasing their references to higher rates for too long of a time will become a problem for us eventually. Right.
Right.
And you talked about, the big change in market expectations just year to date here, going from 6-7 cuts expected for the year down to about 2 as we sit here today. And, we know the market is going to overreact as data comes in. And so what we wanted to do was just take a step back and kind of reassess the potential for cuts this year and the timing of when those cuts could happen. And, what we've laid out here are Fed meeting dates in blue between now and the July meeting, as well as key data reports that they're going to get. So we've talked a lot about CPI here already, PCE obviously being the preferred measure from the Fed, and then of course jobs reports, right? Checking in on the labor market. So Mike, maybe, walk us through this. You can see here how the market's thinking about it with just quote unquote a 30% chance of a cut by July. But how are we thinking about this timeline here, and what do we expect from the FOMC?
So previously, our expectation was the June 12th meeting would be the first cut.
Yep.
That would be a very hot take right now. There's only a 16% chance based on market Fed futures and applied probabilities right now. And basically, if you look at between now and that June meeting, they're going to get 2 more CPI reports, one of them the morning of the meeting. So there's probably just not enough data to get the Fed to a point where they're confident they have enough evidence that inflation is on a sustainable path to 2%. So we're pushing back our expectations. We don't think June will be a meeting where they'll be able to cut. And we talked a lot in prior videos how we think the market is very poised or primed for a rotation out of mega cap growth stocks into smaller cap, more value-oriented areas of the market. The catalyst could be rate cuts. This obviously pushes that rotation back at least a month.
Yeah.
We still think it's going to happen this year just based on the market dynamics and how the whole market is sort of on one side of the boat. But you have to reasonably push that timeline back.
Yeah.
So the next meeting, which starts to look very interesting, is the July meeting, July 31st. So between now and then, you'll get 3 CPI reports. You also have 3 more PCE, well, 4 if you count the one we're getting on the 26th, but that's pretty much in the bag. If you know CPI and you know PPI, you can pretty much count PCE. So they'll have, if each of those sort of come in just in line with consensus, which we know seems like a long shot right now, given everything that's
For due.
the narratives and the fact that we've had 4 hotter than expected.
Yeah.
If they come in line with expectations, the Fed's going to be going into that July meeting with core PCE, their preferred inflation gauge, running at about 2.3% over the last 3 months. On a year-over-year basis, it'll be something like 2.5. But this will be, the evidence that they're probably looking for. 3 solid prints.
Yep.
3-month annualized at something like 2.3. And the other reason why this July meeting starts to look so attractive is you can set it up at the June meeting where you have your summary of economic projections.
Right.
So you can prepare the market, and then you factor in timing versus the election, right? So between now and the election, you have the July meeting and the September meeting. If you're the Fed, and this shouldn't factor into their decision making, but let's just say it does, just humor me, you wouldn't want to start a rate cutting cycle at the meeting right before the election.
Right.
And they've never done that before. So what starting in July allows you to do is you could cut again then in September because you didn't start the cutting cycle right before the election. You started it in July.
Yeah.
You have that option. Or you could skip it, which they'd probably be fine with. And then you get to, they have another meeting in November, the day after the election, and then the December meeting. And in our view, in November and December, core PCE will probably be running around 2, and they would be free to cut.
Yeah.
Especially if there's any weakness in the labor market. They would be free to cut. They would have, the market would give them that leeway to cut if they want. So you put all that together, we think July is now our timeline for the first rate cut. A lot has to happen to get to that point. We need CPI to come in line with expectations, PCE to come in line with expectations, but it looks like an attractive starting point that gives the Fed a lot of optionality. And 3 cuts is still on the table for 2024.
Yeah.
November and December. And then, you could perhaps do quarterly cuts after that, even. So you think about where we're at now and everything we've been saying, the 2 big themes year to date. 1, the market is very vulnerable until the Fed starts cutting. Okay, we're seeing that right now. It took a while, but we're seeing it, right? So defensive positioning is warranted. And then 2, once the rate cuts start, the market will want to rotate. That we still think is coming. It's just delayed perhaps a month.
Yep. Yeah. No, that's helpful. I mean, it's easy to see or paint this picture of the Fed being stuck between a rock and a hard place of wanting to cut, not seeing inflation progress, and then running into the election on the other side. But, very could be reasonable for the Fed to start prepping the market at that June meeting with the dot plot and get that first cut happening in July 31st. One big factor that we certainly don't want to underplay, but, could throw a wrench in everything we're talking about is the flaring up of the conflict in the Middle East, right? The attack of Israel by Iran. And we're seeing some of the market reaction there. You see energy coming back strongly here in April, up 8% year to date. Mike, help us kind of gauge what the potential outcomes could be, and then we can start to walk through what our framework would think about various levels of conflict.
Right. No hot takes here. This is obviously well documented. It appears now that it was Iran's intention to retaliate, not escalate.
Right.
By all accounts, their strike on Israel was a failed military operation.
Sure.
It just went to show the strength of the Iron Dome and the Allied defenses to basically knock out that attack. And the other thing that we want to note, though, is it was not insignificant. This has been downplayed a lot. I mean, Iran, by all estimates, launched about 10% of their artillery of ballistic missiles and drones. Right. You don't just waste those. And they launched them all at the same time. So this wasn't just probing. This wasn't necessarily just a show of domestic force. It was a failed military operation. But for that reason, because this was significant, when you think about now the ball's in Israel's corner to retaliate, them doing nothing is a very low probability of that. Right. Retaliation in some way, shape, or form has to be your base case. So then we're talking about shades of that. Best case scenario is sanctions. That from particularly if you think about oil,
Right.
that's really what we're talking about here, right?
Yeah.
Oil and war. And OPEC Plus has plenty of spare capacity. If Iranian oil was sanctioned and supply was somehow disrupted through that lost supply could be made up relatively quickly. The market would take that in stride.
Right.
The worst case scenario, of course, is direct war. It's a low probability, by all accounts. It's a relatively low probability event that this escalates to that level, given all the diplomacy efforts right now. But if that were to happen, we've looked at a large number of very sophisticated financial models, economic shock models. We've developed some of our own as well. You can add at least $50 a barrel to a price of oil in pretty short order, because you're talking about disrupting production and the Strait of Hormuz getting disrupted as well,
Supply
which is
distribution lines. Yep.
So add $50 to a barrel of oil. You're talking about something around $140, $150 per barrel. You think about the immediate impact into headline inflation, global headline inflation, which includes food and energy. You can increase that at least 1% to 2% this year.
Yep.
And then economic growth in real terms after inflation, you can take that down 1% to 2% globally.
Right.
And those are all very broad numbers. Who knows how it's going to play out? But you just sort of see, so everybody can get an idea of the effects. And then what we can do is take that worst case scenario, run it through our framework, and get a little more specific.
Exactly. Yeah. So if we start looking at the framework and thinking about that worst case scenario, right? You talked about the likely immediate impact to oil prices, right? Of course, here we're thinking about core inflation prices, excluding food and energy. So likely a more lagged effect to eventually what core prices would do. You could potentially see some upward pressure as higher oil prices float into supply lines elsewhere and make goods more expensive. But you could also see downward pressure from individuals needing to spend more money on gasoline and having less money to allocate elsewhere. So I think we would summarize this by, it remains to be seen certainly, but it would likely be a more lagged and certainly more muted effect than what we would see in the oil market immediately.
Right. With this, the market's excited about this dip in core CPI in the back half of our forecast horizon, especially around end of the year. That would probably go away.
Yeah.
So that would be tough.
Yep. And you talked to some of the impact on economic growth, probably looking in, the 2022 growth level, right, of, small single digits, 1-ish% decline in a full war scenario.
And in that time, nominal growth was fine.
Coming from inflation.
Inflation crowded out the spending. And so real growth was very low. We had 2 consecutive quarters of negative real GDP growth back in 2022. That's totally in the cards.
Yep.
If we would get that type of upward pressure on oil.
Sure. And then from a recession signal standpoint, we've talked about how this has remained inactive for some time. Of course, the yield curve signal already is active. If we were to see some escalation to direct war, we would imagine market stress signal would certainly pick up, if not activate. And then kind of similar to the core inflation impact, we would look for that to kind of flow through into the real economy first, and then potentially the labor market, right, from a recession signal standpoint. And then, the biggest factor we've been talking about year to date, this improvement in liquidity that we're forecasting for the second half of the year, a huge wild card would be what would the Fed's reaction be to a direct conflict in the Middle East, right?
Absolutely.
We've had all these factors we've been talking about for 6 months now on the domestic inflation side. How would a war impact that monetary policy?
And we would just talk in circles. Everybody in that situation would just talk in circles, including Jerome Powell. You'd say on one hand, they're focused on domestic monetary policy. What happens in the Middle East is irrelevant.
Yeah.
But
inflation pressures.
Their pillars are price stability, which there would be a lack of. So that would suggest they could keep rates higher for longer. But what are they trying to solve? Higher interest rates in the U.S. aren't going to ease supply disruptions to oil in the Middle East.
Yep.
So that would be like pushing on a string, or whatever term you want to use. And then you have the other pillar, which is the labor market, full employment. And then the unofficial pillar, which is market stability.
Right.
Those would both eventually, markets sooner, labor market
Labor
probably
market
later,
Yep.
call for cuts. So that would be the curveball. If this was ultimately overblown and the domestic impacts were less than expected, but it scares the Fed into doing more rapid cuts, in hindsight, that would probably be viewed as a monetary mistake, but the market would run with it and probably like it. So way too soon to call on that.
Yep. All right. Well, that will do it for us in this version of CapStrat this week. If you have any questions or comments, please feel free to reach out.